This week, a bit of a look to the long term, but mostly just what's happening this week, a bit of a look at the charts, and of course, I'm waiting for your questions as well. So, yeah, just a quick word about myself. I used to be a retail trader, a computer programmer. I founded Forex Crunch back in 2008 and joined FX Street in 2018. My focus is on fundamental analysis, but we'll talk also about the charts. I'm leading FX Street's premium content. Today we'll talk about basically three themes this week. First is China, moving markets, second largest economy. Second thing is speculation about the Fed. And then, well, very related to the second topic, the meeting minutes. This week we have the FOMC meeting minutes. That's tomorrow on Wednesday for those watching the recording. And yeah, and then we'll talk about what's next, your questions. So feel free to interrupt actually at any moment, okay? The session is for you guys. So really no need to wait for the official questions and answer session. Okay, but before we begin, I'll just say that we are leading the premium content section, and we have 20 years of experience. We deal with all kinds of assets. You can access Tomas Sayes, Ivan, Brian, and myself. You can ask us questions directly, not only in this special webinar, but if you sign up to premium, you can tap us directly, and we have other features, trade notifications and alerts. This is our small snapshot of our Discord community. We get lots of positive feedback, lots of access there. We accompany you. We provide daily trading alerts and strategies and all kinds of stuff, really actionable content. And yeah, feedback is positive. What I need to know, when I need to know it. Excellent insights. You really inspired me. These are real comments from real people, from real users. Okay, and yeah, we have lots of experience, and you can tap into that experience, get our actionable content. And yeah, and of course, we also have Black Friday. Of course, why not? So it's up to 75%. It's 75% if you sign up for 2 years, and still a deep discount of 50% for 1 year. All you need to do is click the link right here that I've just shared, and you can access that. And okay, that has been my short pitch for today. And let's talk about what you came here for, to talk about markets. So, COVID, I assume most of you live in places where COVID is not a big issue anymore, but most of Asia is opening. But China is a bit different. We had rumors talk about reopening. This week things are looking a bit worse. We had 3 COVID-related deaths reported by Beijing for the first time in 6 months. So, well, death is always bad news, even if the patients were old and sick. And what was deemed as an experimental city, a place where that would have looser COVID restrictions, a city close to Beijing, they actually added more restrictions, so that's all bad news. Okay, the reopening is going on. It's slow. It's these snails you can see here on the screen. So still 20% of the economy is under restrictions. Okay, and that's, but we don't have any new kind of restrictions, and no draconian action from the government. Okay, so we have lots of new cases, and yes, we have restrictions, but they're not crazy. I believe that the big change will come only in the spring, around March. In March, there's another party congress. So Xi Jinping, the president, won the support of the Communist Party for another term as head of the Communist Party, but he will be renominated as president of China in the spring. That's when there will be a new government, and that's when they can take more action. And in terms of the disease, it'll give them a few more months to vaccinate their population, especially the elderly, and to, well, pass the worst of the COVID season, of like the flu season. It's winter. So I think that's when things will really reopen. Well, instead of snails, I should put here rabbits or something like that, or tigers or whatever. But now we're still in a slow-mo mood. Okay. So we have this kind of sense of hope in markets. but it's back and forth, 2 steps towards reopening, 1 step back, and these headlines move markets quite a lot. It's the second largest economy, and also, it's important to remember, it was also the engine of growth after the global financial crisis, so still very important. Second theme is speculation about the Fed. Data has been, this was, what you see here, this chart is what happened in markets, what happened to the dollar after we had that very weak CPI report on November 13th. Okay, that was or the 10th, sorry, November 10th. That was less than 2 weeks ago, but it still left a huge mark. While inflation is falling in the United States, at least in October, at least for 1 month, and that triggered a huge market reaction. Also, we got weak PPI, but then markets never move in one direction. We got those retail sales figures last week. They were good, and good news is bad news for markets, as we know, because it means higher interest rates. Good for the dollar, bad for stock markets, especially tech stocks, which had their share of issues. Retail sales that was back in October, even before Black Friday. Everybody has Black Friday. And Fed messages were mixed. Let's talk about the Fed. We have these hawks and doves playing with each other. For instance, Neil Kashkari, he was an uber dove, and then he became a hawk, talking about needing to raise rates while services sector inflation rises. But then we had hawks like Bostic and Waller, that they have been a bit more moderate. We need to think, take our time, slow down. Okay, so we had lots of back and forth on that. And now we didn't have that much reaction this week to a few Fed speakers. Again, mixed messages, but now we'll get the main event of the week. Just before Black Friday, just before Thanksgiving in the US, we have the FOMC meeting minutes. Now, please don't yawn too much. It's not only a raw document, it's not only protocols of that decision that we had by the Fed at the beginning of the month, on November 2nd, but actually it's a document revised until the very last moment, meant to send a message to markets. Okay, so the Fed knows markets are watching and it wants to send a message. So I think it will be important, and markets are super sensitive, so I think this will have an impact. So these Fed meeting minutes, I think they will reflect the change in inflation. We had weak CPI, and I think they'll send a more dovish message, talking about the need to slow down the pace of rate hikes, to wait and see a return to, monetary policy actually works with a lag, so maybe we need to wait and see before the next move. That's good for markets, bad for the dollar. And it also gives more of a voice to dovish members. Remember, the statement, the FOMC statement was dovish. It talked about these lags and about having raised rates a lot. There was an accumulated factor. So I believe this event will send the dollar down. We're already seeing a bit of that today after yesterday's rise. I think we'll see a bit more small back and forth until the release. And in general, markets want a Santa rally, want a happy holiday season, and they tend to see the glass half full rather than half empty. So I think we can see a dollar sell-off triggered by the Fed meeting minutes coming out tomorrow at 7 p.m. GMT, which is 8 here in Barcelona. 6 in London and 2 p.m. in America. Okay, the real deal, the biggest market movers, I'm talking about the FOMC minutes as the main event of this week, but let's look towards next week and the one afterwards. We have non-farm payrolls on December 2nd. It's next Friday. It hasn't been such a market mover like CPI, but CPI has provided enough action. So, but yeah, maybe the U.S. economy lost jobs, or maybe it gained only a bit of jobs, and maybe it's cooling down, and that could be positive for markets. Bad news is good news again, but who knows? Non-farm payrolls can always surprise. The biggest event is CPI, Consumer Price Index inflation report on December 3rd, and then we have the Fed's dot plot. I think I have that wrong. It's on December 14th. So yeah, very crazy week to finish the year. All right, so I think the dollar in general is in a downtrend. don't look at what happened last week. Because of the CPI reaction, only another strong CPI can change the direction. And I think the meeting minutes should resume that move. Okay. Any questions so far? As I mentioned earlier, this time is less about a full long presentation, but rather talking about what's going on in markets. I mean, providing a bit of data, and then looking a bit at the charts. But in any case, as I mentioned earlier, you're welcome to ask questions. So let's look at this chart. Well, I'll begin with euro dollar. When I use most of the 4-hour chart. Why do I like it? Because for me, all good, nice information. Thank you very much. Alex, you're welcome to ask any question you would like. I'll continue with the charts, but feel free, everybody, to drop your questions here. So why do I like the 4-hour charts? Because the daily charts are more reliable, sure, but they do not provide enough action, in my opinion. And the 1-hour chart just becomes too noisy, especially when we're talking about euro dollar. So this euro dollar chart, let's talk about what I mentioned. So when you look at the hourly chart, at the daily chart, you can see that euro dollar was in a long downtrend since February this year. I guess I can draw it even more, but it was really trading in this downtrend channel of sorts until it broke higher. It broke above this channel. It happened even before the CPI release, but then it moved, well, not only stayed in range and drifted out of the channel, but moved much higher. So I think euro dollar has turned the corner and is moving up. Well, we have a question. So given the 0.75% expected rate hike on New Zealand dollar, yeah, that's coming shortly. Do you expect rally on New Zealand dollar, both weakening? Yeah, well, I expect the US dollar to weaken in response to the Fed's meeting minutes, and the New Zealand dollar not to react on the 75 basis point rate hike expected from the Reserve Bank of New Zealand, because that's already in the price. That is not a surprise. It's always markets react to changes in expectations, not changes to interest rates, okay? In the previous rate decisions by the Reserve Bank of New Zealand, they not only raised rates, but they signaled even more or higher rate hikes are coming. So it all depends on the next moves. Okay, if the Reserve Bank, the RBNZ tells us we're gonna keep on raising rates very strongly because they have good reasons. Inflation is high, employment is good. A bit of hopes of Chinese reopening, even though that affects the Aussie dollar more than the Kiwi. Then I think the Kiwi dollar could extend its gains, take even more advantage of what I expect to happen from the FOMC meeting minutes. Let's look at the Kiwi dollar just right now. Yeah, and I see the next comment here. Can't charts clearly. Yeah, too many drawings. Yeah, I agree. I'll try to remove some drawings for the next time, or just zoom in a bit. That'll be helpful as well, right? Anyway, well, so yeah. Also, the Kiwi dollar has bottomed out even earlier. Lots of things going in favor of the Kiwi. The past few days, it has been stuck in this range. I think, dovish Fed meeting minutes and maybe a hawkish comment from the RBNZ could send it even higher. So yeah, but maybe the RBNZ will surprise us because they're not as committed to communications like the Fed. They could tell us, wait, we've done quite a lot. Let's stop right now, or let's slow down next month. Maybe only 50 basis points, or we'll wait and see, and that could send the Kiwi down. So again, what I want to stress here is that the reaction does not depend on the rate hike itself, but on what they say about the next moves. Okay, now regarding that comment about too many drawings. There might be, yeah, I agree that there are too many drawings. I would like to ask, what would you see as the optimal number of lines, or see, I'm trying to focus a bit here more on euro dollar, but in any case, how many indicators do you guys use? I'm an advocate of using few indicators because otherwise it becomes messy. And despite this, this approach, your comment shows that even I have too many. So I guess, yeah, can always lower. High, low, middle, and perhaps some order blocks. Yeah, that would be also useful. No indicators, only order blocks and high, low, middle. Okay, that's a nice approach. Just channels, okay. Also interesting stuff. Yeah, I know some people who use, well, stochastics, RSIs, all together. I use here the 50 and 200 simple moving averages, and also on the bottom of the screen, the RSI, and yeah, and too many, apparently too many support and resistance lines. Okay, I want to move to other charts. You are welcome to ask more questions. Let's look at the, oh, here I definitely have too many indicators. Let's zoom in a bit for move to the 4-hour chart. Also too many apparently. Yeah, this already looks a bit better. We can see an uptrend in pound dollar. Yeah, they just confuse price action is price action. So would you say that you prefer what's called sometimes naked charts? Just let's do this. Does this look better? Exactly, yeah. Okay, so if you're used to, okay, less is more apparently by popular vote, as Elon Musk says, Vox Populi, Vox Dei. So yeah, actually for those used to looking at charts for a long time, you can see how there is some kind of an uptrend, but we have long periods here of consolidation, of range trading within pound dollar. Pound dollar has been affected by, oh, it crashed after that mini budget, which was the maximum crash, and then it's stabilized with the new government, and I was looking for a new direction. Some hopes about closer trade ties, well, undoing part of Brexit, if you want to call it that way, have held the pound, but since then it hasn't gone anywhere fast. So yeah, I think it's also waiting for the FOMC meeting minutes. And in general, if you big picture, the British economy is doing worse than other ones. It still hasn't returned to pre-pandemic levels of output. Another thing here to note is 120 seems like a strong line. You can see that on a naked chart, and we have some kind of support on around 117. So that's quite a wide range. I expect the Fed meeting minutes to at least push the pair towards one of those levels. I expect the minutes to push it to the upside. Okay, gold. Gold I know is a very popular pair. And let me also here remove these drawings. I can always draw all these lines once again. We've seen gold jump from the lows there early in the month when 1616 was the low point, reached 1785, and then we have a correction. What's nice to see in this correction of, let me put just one line. I hope it won't bother you guys too much, but if we put a line here, these are the kinds of things I like on charts. We can see that this line around 1730 worked as resistance back in, what was it, early October, and now it works as support. This means it's a very strong line. I mean, again, you can see it even without drawing it, but now it makes clear. For me, this is a bullish sign. If an asset, a currency pair, in this case, a commodity gold, holds onto an old line, has a good memory, and doesn't correct below that, okay, it could still be bullish, but this is even more bullish by having this line as a pure separator of ranges. So I think gold also has room to move higher. Currently, US 10-year yields are 378. They've lost a lot of ground, but I think they have more room to fall if the Fed minutes are indeed dovish. Okay, let's look. I think 1755, 1768, and 1785, 86 over there are levels on the upside, 1730 on the downside, and another big downside level is, of course, 1700, very round. Okay, let's move to, I don't know how many of you trade dollar yen. It's been a mess. Let me also here remove the drawings by popular demand. So, yeah, some of the lines are interventions there, but the biggest fall in dollar yen is not an intervention. That's the US inflation report from nearly 2 weeks ago. And since then, we've seen some kind of recovery. Japanese inflation is moving higher, but it's mostly some dollar strength following retail sales. In any case, we're very, very far from the pre-CPI levels, and I think it has more room to fall to the downside, slip back below 140 and extend its falls. Yeah, nice area of imbalance just above where we are now. Yeah. Yeah, lots of, yeah, it sort of was knocked down, dollar yen, and never managed to fully recover. So around there, 142.50, I would say that would be a cap. If that would be broken, sort of post CPI recovery level, that would be a bullish sign. But for now, things, I think bears are in control, especially if they break below 140.70, something like that, which was a near double top, and then we'll have further falls. Do you expect it to get up to there sometime? No, I mean, I think, yeah, it can go there. What we need is a strong US inflation figure, and that comes only on December 13th. So if we're talking the scope of this week, I think the trend is still to the downside. We would need to get extremely hawkish meeting minutes from the Fed. Who knows, always a possibility, but it's not my baseline scenario. I think it'll go, the trend is to the downside. That dollar yen has turned the corner, topped out, and now ready to fall. Basically, that the dollar is heading down. But yeah, a lot depends on CPI. If we get, let's say, core CPI on December 13th, to get core CPI at 0.7% month over month, it would be another game changer. It would mean one day later, a super strong hawkish Fed decision, where high dot plot signaling maybe reaching 5.5%, peak rate maybe even 6, some members, and then of course it could go much higher. So the levels I'm watching here, 142.70, this post CPI here, and then I would look at this line here, which is 145.25, and then right here, which would be 146.88 more or less, and of course 150. To the downside, I'm looking at this stubborn level here of 140.75, which I mentioned earlier. Then weak support here at 138.90, and the next level to watch is the swing low of just 137.68. But I think it can go much lower. I mean, if we have another weak CPI, it'll sort of cement the fact that US inflation is falling, and we can go even, it wouldn't be crazy to say that dollar yen could fall to 130 by the end of the year, but we would need another, let's say, 0.3% core CPI month over month. Basically a repeat of what we had last month. If we get that again on US inflation, core inflation, we could begin a relatively fast drop to 130. The Bank of Japan wants it. The world needs a weaker dollar in general. Okay, more questions? Let's talk a bit about S&P. Yeah, here I don't have to remove any drawings. Well, also here we can see this bottoming out, and then a bigger boost with in response to that weak inflation report. Still not out of the woods. 130 level is 50-day, I guess. Weekly. Okay, that's a big thing. Let's look at that. Let's return to dollar yen here on the chart, and yeah, at the moment, yeah, it's around. You're right. It's 130, 130.50 at the moment. The 50 week, which is basically a year, moving average, simple moving average on dollar yen. Yeah, that would be significant. If you look at long-term indicators, I would prefer the, let's see, 200-day simple moving average, and we're still above that. Why 200-day simple moving average? Because many market participants talk about it, and that's what makes technical analysis great. That if many people use the same indicators and talk about it on Bloomberg TV, on CNBC, on you name it, that means that more eyes are looking at that, more orders are going on there. So yeah, I would say that the 50-week SMA is significant around 130.50, and before that we have the 200-day moving average at 132.30 at the moment, but as it's a daily thing, it can move. It can still move quite well to the upside a bit more before turning south. But the fact that dollar yen made that sharp drop just below the 50-day simple moving average, I see that as a bearish sign. But in general, if you just look at the chart, you can see that it looks to have topped out. A fall under 135 would be even more significant, but let's see that happening. Contrary to what I said about gold, here we have dollar yen falling below the previous highs. No good separation of ranges. You can see that it fell below the peak there in July, right here, and it also fell below this line here, the swing low in late September. So for me, dollar yen has not maintained a clean separation of ranges, which is a bearish sign. Okay, any more charts you want me to go over, or any other questions? Cheers. Well, you're most welcome. So just to mention once again that we have this special Black Friday offer. You can tap into my knowledge not only here, and not only to my knowledge, also that of Ivan Bryan and Thomas Sayes. Yeah, we have this special offer. Let me do my marketing thingy and paste the link here once again. If you have any questions, any additional questions, thank you very much. You guys are good. Well done. Thank you for the kind comment. So yeah, well, 30 minutes have passed. I'll give another minute or two of grace for. Is there a program for Sam Satan videos? Okay, so yeah, if we go to, let me go to Trading Studio and see when Sam Satan's next webinar is. So if you're a premium member, go here to webinars, Trading Studio. Let me do it. Just a search. Yeah, Sam Satan will be speaking on November 28th. That's next Monday. Well, it's 3 GMT. So yeah. Oh, it's a free webinar. So yeah, he's really good. He's one of our stars. So here's the link to Sam Satan's webinar. You can all sign up. Okay. Plug it. Yeah, of course I will. I'm also a big fan of Sam. Yeah, we have another question here. What's your opinion about Fib levels on euro dollar? I like Fibonacci levels when it comes to extensions, not to retracements, okay? So, yeah, let's look at, for example, let's clean this up to make it easy. So, what I would look at is if we were to have a big break to the upside, I would look at from the last high point. Euro dollar is a bit messy, but not little messy. Anyway, I would look at something like this. So from the last high point to the low point, and that gives us extension. So in case of a big break to the upside, I would look at, let's say, 105.49 as the 138.2% Fibonacci extension. I think there are, at the moment, I would look at just previous technical levels. I think for euro dollar, I would use Fibonacci, again, only as extensions and only to the downside. So if we have another break below, what was it, 95.80, sorry, let me check out exactly how much it was. 95.36, right? If we have another break there, which would be the lowest in 20 years, right? Then the next levels I would look for would not be what levels euro dollar had 20 years ago in 2002 or 3, but I would look at a Fibonacci extension. Let's do it from the beginning. Let's erase this to keep our charts clean. Let's say the peak, we've seen the peak now, and let's say dollar really surges. We have strong inflation, very hawkish Fed, you name it. So I would pull this Fibonacci extension from the low point there at 95.36 all the way to the recent high at right here. Okay, and then I would look at, this goes all the way to 91.76, the 138.2 Fibonacci extension. So that's how I would use Fibonacci to understand uncharted territory. Yeah, bullish monthly developing. Yeah, I see in general the dollar is falling. If we look at the monthly chart of the euro, ooh, that became messy. That looks much better. Yeah, you're talking about the candle. Yeah, the candle looks bullish. Yeah, and in general, yeah, I think we would need to surpass this level, which is 106.28, 106.30. Let's call it, to have bulls really in command. Again, we would need weak US data to have that. Okay, so I see more people have joined towards the end. Thank you very much. Yeah, well, I've surpassed the allocated time. Hope, forgive me, but I'm always glad to answer your questions. Again, you're welcome to join our premium service for those of you who are not there yet. Again, we have a very big discount because it's Black Friday, and take advantage of it. And I hope you've learned something new today. If you're in London, I'll be in London for the IX Investor Conference on Friday, this Friday on the 25th, on Black Friday. So if you're there, come and say hello. And yeah, I hope to see you in the next webinars and on our Discord channel if you sign up to Premium. And that's it. Oh, another last minute question. Do you have an opinion about pivot points? Do you think they're reliable? The short answer is no. I don't use them. For me, if you use pivot points, they can serve as another input. If you want to build, if you use many indicators, sure, go ahead, use pivot points. And if you see many indicators converging at the same line, that makes the line stronger. If you have the pivot point, the Fibonacci extension, the simple moving average, the Bollinger Bands, you name it, all converging at the same place, that makes the line stronger. So if you have one of them is the pivot point, it gives more validity to this support and resistance line, but not as a standalone. Yeah, order blocks. Yeah, these represent real flow, so they're significant. Okay, so hopefully I've answered all your questions, and thank you very much for coming here. We're very grateful on behalf of the team at FX Street. You'll have a recording of this webinar. Again, some of what I talked about will become irrelevant after the Fed meeting minutes, but we talked about long-term charts and about opinions in general about markets. So I hope you've learned something to take home, or maybe you're already at home, but anyway, I mean, figuratively to take home. And and hope to see you soon. So that's it for me for today. See you next time. Thank you and bye-bye.